Evening, everyone. Welcome to Go Trader Insights fallout from the Fed in review with myself and Evan Lucas. Well, whether we like it or not, the Fed's playing the tune everyone's dancing to, and that was probably couldn't be more obvious from last week's meeting. We've seen the volatility since that FOMC meeting last week, with extreme volatility in FX, in equities, in commodities. You see flush crashes in the pound, intervention in the US dollar, the yen, both dollar yen. So to talk a bit further on what we think of what the Fed's actions were and what could happen.
Oh, I think we've lost
going forward. Yeah, welcome to the presentation. I'll pass it over to Evan now to start. If there's any questions, feel free.
Hi guys, as always, it's been an amazing week. As always, before I start, don't forget I do like trying to answer your questions as we go. So over on your right hand side of your control panel in your GoToWebinars control, just click on that questions and fire them away as we go along. There's going to be a lot to cover. I have tried to limit myself to talk probably FX today, because I think that's the best way to look at this, because the FX feed goes through to equities. So if you are industry trading or you're doing share trading as well, you can sort of garner from what I'm going to talk about how that fallout is. So for instance, everything's running to safe haven currencies, particularly the US dollar, obviously, and I'll talk about that. Everything is running away from bonds, running away from equities, and anything that else is seen as risk. So we'll talk about that in the main. But I mean, I wish this morning I sort of was sitting there asking myself a question of, do I make the joke of having, after the disclaimer, as always, guys, have a very good read. Go Marcus doesn't know your personal scenario, nor your personal financial goals. So none of tonight is any form of personal advice. It is just general in nature only, as always. I was thinking that maybe this first chart point should have been not this, but actually a picture of Ron Burgundy saying, well, that escalated quickly. And why I say that and making the joke about it, because it is almost comical about what's happened, is this was the lead into the dot plot. So those of you that came and saw me 2 weeks ago, this is the exact chart I showed you on the night of the 13th leading into it. You can see very clearly on the left-hand side, sorry, that if you look at where the federal funds rate was expected to be by the FOMC members by the end of this year, so December 2022, it was expected to be between 3.25 and 3.5%, giving you that target range of 3.375. That's what it was leading into the meeting. Expectations were that at the December 23 close, that it would be 3.75, and then long run, over the longer run, which is pushing out towards 2026, 27, they'd be cutting rates and coming back down to 2.5%. That was the lead in. This is what actually happened. And let's really look at what this is. This is a proper escalation of what they are now doing around rates and where they are from now, where that therefore goes. The dot plots, the jump is incredible in terms of where it is. You are talking about a full 100 basis points increase from the July meeting to the September meeting in where they think rates will be by the end of this year. And you can see very clearly there that the expectation is it'll be between 4.25% and 4.5% in terms of where it sits. The interesting still part about this, the market is actually slightly behind them. The market is still slightly behind the curve in where they think, and you can see that in both the black and the blue lines of where they are at. So at the meeting on the 22nd, which is the black line, obviously I only took a snap the day after, apologies, on the 23rd, which was last Friday. So there hasn't been much of a deviation, but you can see already in one day they are taking it into effect, and it was already gapping up to say that at the end of next year that the federal funds rate will be 4.5% in where it is. That means higher, longer, harder. That is the three takeouts that you need to look at. What this is telling you is that the Federal Reserve is going to forego everything else, growth, unemployment, etc., to chase inflation. And they are talking tough, and they're now acting tough. And that That was the whole premise of what it is. What is also staggering is that the consensus next year is clearly there, that they are getting even more hawkish in where they spit. And therefore, we've got November and we've got December. And where we're coming. So we've got the November meeting, the December meeting, then you go into next year. First meeting is actually in January. Then you've got March, April, May. That is what they reckon will be the peak. The thing is, once it gets there, they're not going to let it go. So I've just got a question coming in from Tony. Do you expect more bad news, or is this it? Has the market made a bottom? First and foremost, Tony, never ever know where the bottom or top is. I will always tell you that very, very honestly. Do I think it's the bottom yet? Maybe. So I think I've spoken about this before, and I'll say it again. Bear markets end in a whisper, bull markets end in a bang. And we're in a bear market. Let's put that out there very, very clearly. And we are in a strong bear market at that. What hasn't been declared yet is a official, we've got a technical, but not an official US recession. And why it matters, and if you remember a couple of presentations ago, Lachlan and I were talking to you about that the recession indicator is huge, particularly in the modern day, that when the US has declared a recession, that has actually tended to be the signal that they are going to bottom out. Why? Market goes, this is as bad as it's going to get. They also know that therefore fiscal and monetary policy have to come to the fore. They can't keep going the way they are because you've now got an economy that's contracting. That's what's happening. So you have to start moving. Markets, under theory, what you learn at university and when you start doing all what we do now, is that equity markets are thinking, or trying to anyway, price 12 months ahead. So what does, not today being what, the 28th of September 2022, but what does the 28th of September 2023 look like? So that's why it's always very hard to answer that. So I don't know, Tony. It could be. It could well be that September is the final shakeout. There is always an argument to be made that this is a shakeout. It's a particularly bad September. The ASX is down 8%. The S&P is down about the same. In fact, a little bit more. So maybe there's a big maybe there, but I can't say any more than that. What I will say though, what's different this time is that this is telling me that the Fed is going significantly harder than I think has been fully appreciated. Monetary policy hasn't been this tight since the 80s. And why I say that, let me move on to my next thing. This also caught my attention like no tomorrow as well with what's going on. Apologies, I keep moving around here. I'm just trying to see what I can see with you guys as well. I wanted to show you this in terms of what it is. This was what the US yield curve looked like leading in, and then this is what it now looks like. So if you look at this, already this chart, this is leading into it. It was already forecasting that there was problems on the horizon, that the 2-year, as you can see over here, the 2-year bond, which is that one, is above the 10-year. So you've already got inversion, the forecasting of what's going on with a recession. You can even see 3 months ago from where we were, it was there, but not as bad. And go back 6 months, and then a year ago, who would have thought that this was what we'd be talking about? But since last week, it's just gone ballistic. And this is possibly the weirdest yield curve I think I've seen for the US in my living memory. I don't know about you, Lockie, but I cannot say that I've ever seen anything like what this is. To see the 2-year bond now trading at 4.25%, and the 10-year is down at 3.6. It's a 50, between 50 and 60 basis point difference. That is the highest difference we've seen since 1981, when Paul Volcker, which was then the head of the Federal Reserve, was just going ballistic with rates. He would move them 400 basis points, so 4% 1 month, and then cut 450 basis points the next meeting. And there's also the inversion of it. And you can see even a month ago, it was thinking something like this was going to happen, but the jump up has been astonishing. And what this has meant, and I'll come to this in a minute as well, what this has meant is the attraction to the US dollar off the back of this is incredible, because the bond market, and why I keep going on about the bond market every time, and I know some people hate it because it is a little bit technical and blah, blah, blah. It is such a good indicator and director of flow in FX. It just is. It's such a good indicator of where all of the big money is actually sitting. Because technically anyway, bonds are the safest assets, investable assets that you can get, right? So they don't have the risk attached that equities do. They don't have the risk that FX has. So this is where you're supposed to be, right? This is where the institutional money is supposed to be. But even the institutional money is getting absolutely towed up and taken out to the woodshed and chopped up. So don't feel bad either. That's what I think I want to also point out here. Your trading right now, I know, is difficult. You are not alone. There are big players out there that are, absolutely just having themselves the worst time they could ever imagine. But this to me is fascinating in terms of where it is and what's happened because of the Fed.
You point out even too that, sorry mate, the yields obviously move inversely to the bond price. So those yields spiking has seen the bond price itself getting hammered, which is very unusual to see bonds and stocks go down at the same time. It's most in normal times they're almost inverse. As stocks go down, people jump into bonds for safety, and the bond price goes up. So to see both of them tanking at the same time,
there's an interesting point. Yeah, and what, like you said, is absolutely bang on. There's an interesting question that a lot of people are actually starting to ask me, and all different walks of life with regards to this. Is the other part about that is that don't forget that bonds, when they mature, so obviously if it's a 2-year bond, it's for 2 years. It's like just think about it like a term deposit, right? You've got a term deposit that goes for 1 year, and you get your money back after 12 months. The reason fixed income's a bit further up the risk curve is that fixed income, bonds, corporate debt, etc., has the yield component, which is what we're talking about right now. So the amount of money it's going to give you for coupons, but it also has a capital gains component, right? So your bond can actually go up and down above what we call face value. So when a government issues in Australia and in the US, it's $100 or £100 if it's a gilt or whatever it might be. That $100 is guaranteed to you. You will get that face value back. The thing that you've got to remember is that if you're buying them at a premium, a couple of years ago, you could be buying Australian government bonds at about $104, $105 a lot, which means you're $5 over what you're going to get back. So you're already got to be aware of that in terms of where it is. But there is an argument to be made right now. Some people are pointing this out, that if you are willing to, you're getting discounts. Now, the US 10-year is not the one to look at. The US 2-year at the moment is trading about $87 to where it is, which means that in the maturity of whenever that could be, now the 2-year maturity, there's about 3 of them out there on the market. In 2 years' time, you're guaranteed $13 back per unit because they're going to pay you back the face value, which is $100. And you're going to get about, at the moment, 4.2%. So there's an interesting inflection point here. Some people have been asking, is that should I actually be buying bonds and not worrying about it holding to maturity? Well, possibly, if that's what you want to do. But that's another way to answer Lockie's way of putting Lockie's point into consideration, is the discount now in bonds is getting interesting. And again, back to Tony's question, is this the bottom of the market? Maybe. The thing that you've got to remember, though, is that rates are going higher, and that therefore will push bonds anyway. So you're probably going to see them go further lower still, but it's just another thought process out there for you. I've already talked about that in terms of the slope, and that is certainly something to be aware of. As I said, you have to go all the way back to 1981, and I didn't have the data for that. I do apologize. So what I want to now do is I want to actually do what we should be here to talk about, which is how do you trade this? What has the Fed left us for trading? Where should I be positioned? Blah, blah, blah. How that all works out and what have you. So what I've done here, and I do apologize, I don't know why that little square has jumped up on my screen grab, but these are the main central banks that you should be worrying about, the 5 that really matter in terms of, particularly for us here in Australia. Normally I wouldn't include Oz because we're not as big as that, but we should because we do look at it. And first and foremost, there are 2 things to concentrate on. The orange line being the US, we know where it's at 3.25%, and going higher. Expectations will be that it'll be off this chart by the end of the year, 4.25 to 4.5% by the end of the year if the Fed is to be believed. So that is a long way up from where we currently stand still. You can see we here in Australia are chasing them at the moment. We're 2.35. at the moment. We are going to get rate rises next week on Tuesday, so be aware of that. We know about the UK, and the UK is fascinating, and I am going to leave that because I hadn't told you at the start, and I will do this now. I am going to do at the end of this a little bit, 10 minutes, on what the hell has happened in the last 72 hours in the UK and how they have absolutely blown themselves up, and particularly those of you that are exposed to cable. I will come to it. I will talk about it. It will be taught in textbooks in the future about just what a time in the world to be doing what they're doing around tax cuts and how they're going to do it. But you can see that already the UK cash rate is the same as us here in Australia. It's a little bit lower because they didn't have that 10 pips problem, 2.25%. But there is every argument to be made that it will have to raise rates at their next meeting. They didn't do it last night at their emergency meeting, but at their next meeting, a full 1% to catch up with what they've got. The euro area, fascinating. For the first time, as you can see on this chart here, as far back as 2015, I should have gone further, I do apologize. It goes all the way back to 2011. They are no longer in negative rates. And the Eurozone has been dragged kicking and screaming out of that space. It makes interesting for euro dollar because euro dollar has been the carry trade over and over and over. It's so incredibly cheap to borrow over there. That's what they want you to do. They basically were paying you to do it. And you could borrow money in Europe, nick over to the States, get yourself some yield, do well with the currency as well, and Bob's your uncle. Now you've got Christine Lagarde and co talking about 75 basis point lot rises to try rein in inflation in Europe, and it's going to be fascinating. The final one is Japan. And why Japan is also incredible is last week, I was surprised that Hikaru Kuroda didn't have a heart attack when it came out that Japanese inflation is now at the highest level it's been since 1981 at 2.8%. Now, that doesn't sound like much in the current environment, but this is a country that has been stuck in deflation or some form of disflation for almost 2.5 decades. And for it to snap out the way it has, their target is 2%. So they're 0.8 of 1% above that, and it's going higher. Yet, last week we saw on Friday, Kuroda and the rest of the Bank of Japan board approved the idea that they are not going to hike rates. So they are the only one bucking the trend. And that probably comes to my next thing to talk about, which is dollar index. We know it's on the way up, but I want to jump ahead and I want to talk about this because this is the other major story that has come out over the last couple of days to a week. Lockie's already alluded to it. You now have what we always refer to on this chat as about one of the best ways to really understand FX, in my view, is the difference between central banks, because that's really how a currency pair works, right? It is the differential between how central bank policy is being priced. That's what they're doing. That's, why is the US dollar to the Japanese yen worth X amount and how they interact. So you're always looking for that idea about how you get to this sort of principle of understanding the difference. And at the moment now, the differential between the BOJ and the Fed is absolutely stark. We knew that. We also know that Japanese investors absolutely love yield and have been chasing it. But out of nowhere, because a week and a half ago they said they weren't, but all of a sudden last week, the Bank of Japan jumped in on Friday and defended the yen. And this is something that was probably caught a little bit of people out of surprise, but they actually went in and bought several trillion yen, which in a US dollar terms is several billion yen, to defend it at 145. Now that needs to be part of your thinking straight away with this pair, is that you now have a known major player in the Central Bank of Japan that is defending a certain level. And the reason for it is that the impact on inflation, the impact on consumption is getting out of control. Don't forget, most commodities in Japan have to be imported. They do not have the ability to get their own gas, their own oil. They don't have any form of mining of any description at all. And everything is done in US dollars. So they have a massive problem around basic cost of living issues, dealing with a currency that is doing, as you can see on screen, something incredible in where it is. So finally, there's a defense. So that needs to be part of your trading now, because the dollar yen trade has been beautiful. It has literally gone from 104 at the start of the year to 145 where we are now, with almost unabated appreciation. And Mike Smith last week, the week before, showed you some beautiful charts about where it is. But fundamentally, the Fed has changed this trade because the Bank of Japan now has to get involved. So there's now an absolute resistance to be aware of at 145, and you need to have that in your thinking about what you're doing with it. Don't be surprised. What I'm saying to you though, it's going to test it fairly hard. The dollar trade is still there. The reasons fundamentally for the dollar to keep going up is there, but you've got a BOJ in there. The question that also comes with that, and why it's fascinating from my side, being the fundamental side rather than the technical side, is that what if the Bank of Japan fails? What if they cannot defend that level and it gets away? And why that matters more than anything is that as soon as a central bank loses credibility, you will have absolute chaos in trading and absolute chaos in something. And the yen would lose all credibility, and it would be on for young and old. I mean, look what happened here in Australia. If you want to go really a bit small scale, and it is much more small scale, without I never say this properly, yield curve control mechanism around the 3-year, when the RBA lost control of it at the end of last year. And it went ballistic, and they sort of like, nothing to see here. But what happened was credibility was lost. So the Bank of Japan has now told you that they're in the market and they're there to do something credible. I'm just going to stop. There's a couple of questions there, Lockie, that I think you might want to jump on.
Yeah, just with the yen, mate, I remember trading this back in 2011 when it was at the other end of the scale. And the Japanese were doing the exact same thing. They were jawboning and talking about it was too strong. They were going to sell the yen and intervene. And there was quite a few little interventions that were pretty good selling opportunities, to be honest, in dollar yen, because the market loves to test central banks, especially the Japanese. They just love to tease them a bit, I think. So we could see something similar, I guess, to what we saw in 2011 with a few interventions that didn't work. And then they finally came out and did a really big one, I remember. But I think once the Bank of Japan's in, you'd be pretty brave to take them on above 145.
Yeah.
But certainly, as you said, there's going to be, I reckon, a lot of chop between 140, 145. Every intervention there's going to be bought to test them again. And I mean, where are they getting the US dollars for this intervention? I mean, I've read they're selling bonds, which is lowering bond prices, which is sending yields up, which is pushing the US dollar up. So they're in a kind of a spiral that's going to be very difficult to get out of, I think.
Yeah, and that's exactly the point. So you've hit the nail on the head there, Lockie, is that they have a self-perpetuating problem. Where do you raise the money required to defend your currency? You've got to sell the reserves you have. If you're selling those reserves, you're impacting the market that's in, and therefore you're attracting people towards it, and you get a self-fulfilling prophecy. The reason I wanted to start here with dollar yen is because it has been one of the trades in 2022, which is interesting because normally dollar yen is a pair that I would argue is a very, very tricky place to be. There is a lot of money has been lost in this pair because there are some weird and wonderful and wild things that go on inside of this in terms of where it is. But this year, all of the trends, all of the fundamentals, all of the technicals have told you one thing, and that this pair was going one way, and that was up. And that has certainly been the trade. If you look also, so then let's go to that next level. The next question would be, okay, do you look at the Nikkei and where it goes? The 225 is a difficult place to be. I know Go offers it to you in terms of where it is, but it's a market at the moment that has got so many other headwinds on it that I just don't watch it anymore. I just can't find a trade inside of it, and I haven't, because again, the trade for me, if you're going to go towards the Japanese market, has been the currency rather than actually the equity market. So that is where I've seen it. But I do want to start here with regards to talking through this, because it's been amazing to see for the first time in very, very long time that the Japanese yen is now being actually altered by the central bank, and where that now goes on. So the next pair to look on from there is this one. And I said I would come to this, and I would give a few minutes in terms of what's going on inside cable. I know some of you that have been on here for a while have been asking Lockie and myself, and when Mike was here as well, where was cable going? A lot of you have told us that you are long cable, which is hard to hear, unfortunately. And where the trend, as you can see from here, was that it was heading lower, but not like what's happened. So the Fed has certainly accelerated this. The pound has got some structural issues facing it before what happened on Friday, and I'll come to that in a minute, which is that we know that we have a shrinking economy. You have inflation that will be double digits. You have a central bank that is raising rates as fast as it can, but maybe not hard enough. It also hasn't got any mechanisms around, well, anyway, yet around really proper quantitative tightening scenarios. So if you take all that into it, that's a weakening economy. It's not an attractive currency. It's a risk currency technically. It's highly exposed to things like commodities. It's highly exposed to resource for trade. It's highly exposed to also finance. So all of that's a negative thing at the moment. And then let's come to what the new Prime Minister and Treasurer have done. What a time to be stimulating your economy. So you've got near enough to double-digit inflation, and you've got a government now that has decided to remove the 45% tax bracket, rejig the rest of the tax brackets, and the way they are going to do this and fund this is with debt. So they're going to reissue and issue new government debt to offset the loss of taxation that they would have got from personal income tax. It's a stimulatory measure, yes. The theory is that it will help the growth of the UK economy by getting, more back into the taxpayer's pocket. Under theory, yep, get that. But when you've got the way you're doing it to fund it by using your own debt scenario, that is what the market is now picking up on, and why someone like Larry Summers, for example, is calling this one of the most economically diabolical decisions you could get. Because why it's happened is that you then, so of this, I'll come back to this chart. What has happened is that now you have a scenario where Bank of England's raising rates, the federal government is using debt to fund the offset of the tax cuts that it's doing, which means the borrow costs of the government is going up and up and up, and it could actually accelerate the possibility of a UK default. And that is what the market is now really picking up. Are the UK storming towards a default? Because all of a sudden the cost of funding, and you can see this here, what this chart is telling you is that the 1 year and 2 year bonds in the UK, or gilts, sorry, as I should use the appropriate term, are at 4.75 and 4.5% respectively for a government that is the 6th largest economy on the planet. And this is why the market is just completely thrown the baby out with the bathwater, and why they have absolutely shed the pound, because nobody now wants to be holding the bag when the UK does hit the wall. And that's what the theory is. That's what the market is telling you, and why it's reacted so strongly to this new idea. And that's why when it came out on Friday, this trade was astonishing. I mean, what I wanted to show you and why I put the candles in is that it actually hit 103 at the bottom there. Now, yep, it's stabilized, but there is every sign at the moment that this could go to parity. It's at a record all-time low. This also needs to be pointed out. This is the lowest the pound has ever been to the US dollar, and will probably go lower still, because the way that this is happening is being done with a mechanism that is fraught, absolutely fraught with danger in terms of that space. And yes, Roger's just come in, government not stable, and I agree with that. That's the other thing to point out. I mean, we are now through, Liz Truss, Boris Johnson. Before Boris Johnson, we had the David Cameron scandal, et cetera, et cetera. Sorry, I forgot the one in the middle there. You had Theresa May as well. Don't forget, you've had, 4 different Conservative prime ministers that have, had all sorts of issues. Brexit, I mean, David Cameron probably triggered this whole thing. If he hadn't have gone for the referendum for Brexit, this may not have happened. But here we are in terms of where we sit. So I agree with you, Roger. It's an unstable government. You know, we're still 18 months away from a general election in the UK. So there is still a lot to play out here in terms of where it is. In fact, it's more than 18 months. It's actually 20 months that we've got before a general election. So who knows how Liz Truss is going to handle this and where this goes from here. But this pair is the next thing to talk about. Again, getting back to fundamental differences and using what I dub, which is the fundamentals. The BOE and the Fed are clearly on a similar path of rate hikes, but the reason for it is different. You've got a UK that has an energy crisis, a falling economy, rampant inflation. The US has got incredible employment, very robust growth, inflation that's also out of control, so we need to rein that in. That's the way to look at it in terms of my view. So it's clearly the strength is to the US dollar side, and that is there. The other thing to point out is that probably unlike the BOJ, the Bank of England is unlikely to interfere with the pound. It is unlikely to defend it. And that will be the next question to talk about in terms of where it is. So that means you can use your technicals, you can use the momentum to look at this pair and think about what that trade might be. Yes, it will snap back every now and again. Yes, there'll be some individual changes, and the next one of these that we're doing that I will raise with you that is a risk event is the US midterms, right? So the US midterms are coming, and that could be the circuit breaker that slows the momentum of the US dollar down. But we'll talk about that at the next meeting. But in all things being equal, and all things that we know now from what's coming out of Downing Street and out of Westminster, they are going to go through with this. It is fraught, as I said, with danger. The markets are certainly aware that it's fraught with danger, and they are shelling it at a rapid rate. And it's a very, again, fascinating time to see all this going on in where it is and what's been happening right now. Lockie, anything to add there?
Oh, I was just going to say, mate, that I've been trading Forex and watching the Forex markets a long time, and I can't remember like a 2-day plunge as big as I saw in the pound on Friday and Monday. I mean, I've seen 1-day moves as big as any one of those days, but to have 2 days in a row where it's just, it's enormous moves.
Enormous. And I wanted to show you this. As you can see, this actually, again, I probably should have gone longer, but because otherwise it gets a bit too messy. But to see 42 basis points added, 42 basis points added to the UK 10-year government bond in one session is just the stuff of nightmares and the stuff that you never, ever see. And that's how much of a change this was in terms of where it is. And it just showed all sorts of problems that is facing the government, what they're trying to do. Because as I said, what they're trying to be, their principal idea is that the stimulus that they give now will mean that as people get more consumption, there's more tax coming in, there's more employment, blah, 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 that they will recoup the tax cuts by having more people employed, the economy growing, therefore the government, the corporate receipts get bigger as well, blah. So it's taking trickle down economics to an absolute nth degree. The market doesn't believe that they can do it, and that is the way to answer that. And that is what this chart is telling you, is that if you're going to use debt to fund what is a pretty out there theory, we're going to charge you for it, because it's just such a risk to bondholders to have the UK government basically borrowing like drunken monkeys to try and fund their economy by giving tax cuts through, and that's the reaction that you're getting. And again, if you're trading this out there, it will snap back. Don't get me wrong. Like, there will come a point where it'll peter out. This is probably a bit of an overreaction, but again, it just shows you how difficult things have been. And the way I would look at cable is, you look at the difference. Where's the difference coming from? Where's the strength? It's one side of the equation, and it's the denominator, and that is no doubt about it. It's still sitting with the USD in terms of that trade and where I would position and what I would be doing in. And there's nothing that is suggested in the last 24 hours or in the next 48 hours to come that the UK government's going to change their minds and therefore reverse this whole scenario that we currently see ourselves in. So let's come home to sort of finish off before I get you right into some questions. Because the other question that always keeps getting to me is, where do we sit in this? Where is Australia going? How much further do we have to go in our rate rises? what is the RBA going to do? We always get called the lucky country, and I agree with that. We are lucky. We always find ourselves sort of doing backflips and landing on our feet. But some of that luck is created. Like we position for it. And what I mean by that is we have our commodities, which certainly back us up on growth. We, as a nation, are net importers of funds, but not to a level that has to fund, welfare, etc., like you do in Europe and the UK. We also have a reserve bank, whether you like low or not. I'm talking about the whole thing over its history, that tends to be quite reserved, quite conservative, and very, very moderate with what it does. So all those fundamental things that I just highlighted, why that matters is that we are going to be hypersensitive, more so than most other nations, to rate rises, because we do have a heck of a lot of our money tied up in property. That is a true fact and an absolute, certainty that we need to be aware of. We also are much more likely to change our spending faster than other nations when costs get more expensive. We tend to be more sensitive to it. As a nation, we tend to be much more conservative with our money than the US or Europe, for example. So why I've given you all that sort of behavior background is that at the moment, you can see our yield curve, hasn't inverted, so we're not being forecast to have a recession here in Australia. But also, if you have a look at that yellow line, what's the latest pricing? Yes, it's all moved up, as you can see, from where it was a year ago to where it was 6 months, 3 months, and to where it is now. Yep, that's all moved up, and that's fair point because we've got rate rises, but they are not at the level that you're seeing in the US. They're not at the level that you're seeing in the UK or sort of also in Canada. Yes, there is an argument that some people are showing that the end of next year the cash rate could be at 2.25% from the interbank market, but that is based on US data, etc., rather than looking at the Australian data. The difference between overseas and here is that our employment market has been better, but hasn't led to a wage explosion like they have in the States. There are still 3 million people that haven't come back into the workforce in the US, despite the fact they've got unemployment that was now at 3.5%, which is as good as it was pre-COVID. If you look at the participation in America, it is 3 million people less than it was beforehand. Here in Australia, it's the opposite. So we have the highest level of participation we've ever had. We've actually now created more jobs over the COVID period back to where the trend that we were doing pre-COVID, and we don't have the wage growth. So we don't have the inflation pressure that the rest of the world does. Yes, supply side is there. There are certain parts of it there. So that is the reason I say all this, and where I'm leading to is that there is an argument to be had that the RBA could actually start to slow down. And we've been hearing them say this, that they're going to probably slow down their rate rises. They will raise next week. That is a given. But do not be surprised to see it at 2.5% rather than half of 1%. And then them doing it again in November and December. And then probably pausing because they are getting very close to terminal. They know the pressure it's coming, the impact it's having will be enough. So there is a difference here as well, which I think is really fascinating to be aware of. And that sort of gets to the question about where the next thing will come with the RBA. And the trade off that is the Aussie dollar. Where that leads the Aussie. The Aussie, therefore, is at the whim of what happens on the US dollar side. We've seen that. It's now gone down to 64.36. It hit last night. It's popped back up. But I do want to show you where you're at with it. The trend is lower. The part here is that the loose correlation with resources. Resources have been sliding. So the one to look here is Dr. Copper. The reason we call it Dr. Copper, it is the best indicator of construction activity. Copper is used in so much construction and infrastructure spending. And to give you an example, it's gone from $10,500 a ton on the LME down to 7,200 a ton as of last night. So that also probably explains that trend that you're seeing, pretty much from around about May this year where we are now, and that slide down. Then you've had the acceleration from the Fed as well because the US dollar is taking over. Do I think it bottoms out to where the low was in 2020 from COVID? No, I don't. I think there will be a bit more of a support floor there because our economy is stronger. We will get better tax receipts. I mean, already coal is showing you that. You're already seeing that with things like iron ore. And so there is a support that can probably cap out the Aussie. So I don't think it will slide to an absolute nth degree, but there's an argument to be made that it will probably go around to about 63, maybe even as low as 62 cents in the coming period, because the RBA is not hiking as hard and the US is going harder. And that therefore would be a short-term opportunity to look at, is that, yep, the negativity is there, it's sold, being fully aware that the snapback could happen quicker than we realize. But as you can see, the trend over 2022 is lower. And I think that's a fair call. But there will come a point where the economy in Australia will show that it is resistant and robust, will show that we are in a better position than most, and there will be an attraction to that. And particularly considering that the Aussie will therefore be considered cheap as well, is the next part of it. So they're the parts that I wanted to show you tonight. I know I've supposed to concentrate on FX, and I've done that for a reason, because I think right now, understanding FX will allow you to think about everything else about where you are. I'm just going to pick up before I ask for more questions. Tony has put in here a question. Is the BOJ smart in not hiking rates? This is a question, Tony, that economic professors currently pose to themselves in terms of where it is. So I'll caveat that with, this is my opinion. At the moment, it probably is smart that they're not doing it. They don't have a level of inflation that's really taking off, but it's coming. They're also trying to continue to basically carry on the Abenomics era of trying to get the three arrows of more sustainable growth in Japan, and it's probably more worth their while to allow inflation to run a bit than trying to slow it down. So the answer may be yes, they are being smart, but it's more about, this has been their longer term policy now for a while, that they're trying to turn the Japanese economy, which is a very slow moving beast, around, because it was stuck in all sorts of turmoil all the way up to about 2012. Abe has certainly helped that, but it's certainly not at a level that he was hoping it to be at before he finished. And obviously today's a very sad day. It's the ceremony for his passing after he was assassinated in July. So I actually think the BOJ is sticking to that mandate rather than anything else with regards to why they're not hiking rates. I hope that answers your question. Are there any more questions from those out there?
I'll have a go at Douglas. I can see he's written a long one there. Douglas. Yes, the Beast of Jekyll Island. It really doesn't, I guess it doesn't matter. I mean, yeah, the motivations, if you feel that there's forces working that are trying to enrich themselves or nefarious means or whatever, but as traders, I guess what we need to look at is how we can profit from it, rather than go down the rabbit hole like too much of what their motivations are of these players. But I think with the presentation tonight, we can see what's driving the market, and that's what you need to look at. Don't need to try to look too deep into some of the things behind the curtain, but to profit from trading, just need to understand what's on the surface there, the interest rates, the central bank policies, etc. So I hope that kind of answers your question anyway.
Was there any more questions out there?
USD resistance level at 120, is that the dollar index?
Oh yeah, good question, Val.
It's pretty much just open sky up to that level, isn't it? It's very well get there.
So the way to remember with where dollar index is, the biggest part of the basket is euro dollar. So have an understanding about where euro dollar is going. It's started to moderate. It's starting to hold at that parity level, which is interesting to see. If you look at Citi and JP Morgan, I think we spoke about this about a month ago, they forecast that the pair could get to about as low as 96 cents. So that would certainly help it go towards 120, Val. But again, it's just slowed down. So maybe that could sort of slow down the appreciation that is inside the basket. But as I said, dollar is king, and the more and more the Fed goes the way it is, the more and more the dollar will remain that way, and the slower that other central banks are to react to it, the more decimation that's going to come to that individual pair. I think that's the way to answer that for you. I hope that helps. Roger's coming. Will US housing loans start to default soon, and how bad will it get? Brilliant question. So if you look at the US 30-year mortgage, it's now sitting at about 7.75% to 8%. The defaults will probably come in 2023. Will it be subprime? No, it won't, because the difference this time is the banking space is much, much better capitalized. The banking regulation is much, much higher, but defaults will happen. They don't, however, have a market like we do here. And I think you need to remember that is that they have about 100% debt ratio. We have 180. So they aren't as sensitive to interest rate rises as we are. And that's probably part of the argument about why the Fed is going that hard. And I can actually see in your second part here, I don't think it's as bad as 2007 and 8. And I completely agree. But there's no doubt the whole idea of what they're trying to do is to create consumer pressure. They're trying to contain consumer demand, aggregate demand along that whole lines of reining in inflation, and therefore that does mean upward pressure on loans, because if you've got to service your loan and you've got less disposable income, then obviously that's the aim of the game of the Fed. But there will be individuals that will be pushed to the wall and therefore will be forced to sell, and that will be a very hard time when that happens. So yes, it will happen. Personally, for me, I think you'll start to see it in 2023. Thanks. Thank you, Tony. I'm glad you liked it. Anybody else out there for a question before we wrap up? I think that's it, Lockie. I think we'll end it there.
Okay, mate. Thanks, everyone. Yeah, it's a very interesting time. Interesting times we're living in. As I said, I've been trading a long time, and this is, I think, one of the certainly most interesting times I've been trading, with the volatility and the fundamentals that are really just driving the market to these massive moves. And I don't think it's over yet. I think we're going to see a lot more of it by the end of the year, to be honest.
I'd agree.
So there's a lot of opportunities. I guess my advice is just to be nimble and be careful. Understand the fundamentals a bit more on your trades. I've seen a lot of people, unfortunately, buying or selling currency pairs that are overextended, thinking they can't go any further, and they just have. So being aware of the fundamentals will really help you with the trading too, I think. So it's a good first step, absolutely, to come to the webinars like this.
Guys, thank you again for having me, and look forward to seeing you at the next one.
Thanks, Evan. See you all.